Imagine a world without money. How would we trade? Perhaps you'd offer a few chickens for a bag of wheat. This system, known as barter, was humanity's first attempt at commerce, but it was incredibly inefficient. What if the wheat farmer didn't need chickens? What if you couldn't agree on how many chickens a bag of wheat was worth? This fundamental problem, the double coincidence of wants, meant that for a trade to occur, both parties had to have exactly what the other desired. This limitation severely restricted economic growth and complexity. Early societies needed a better way. The solution was to find an object that everyone agreed had value. This wasn't about the object's intrinsic usefulness, but rather a collective belief in its worth as a medium of exchange. This is the origin of money. It's not just currency. It's a social agreement. Early forms of money were often commodities. In ancient China, cowrie shells were widely accepted as payment. In parts of Africa, salt blocks served as currency. For the Aztecs, it was cocoa beans. These items were chosen because they were durable, portable, divisible, and, most importantly, widely desired within their communities. Everyone agreed they were valuable, so they could be used to buy anything, solving the barter problem. The value wasn't in the shell or the salt itself, but in the shared trust that others would accept it for goods and services. As societies evolved, so did their money. Carrying around large quantities of shells or salt was cumbersome. The next logical step was metal. Metals like gold and silver were more durable, easier to carry in small amounts, and could be melted and minted into standardized units like coins. This innovation made trade far more efficient. A coin's value was initially tied to the weight and purity of the metal it contained. If a coin contained 1 gram of gold, its value was understood to be 1 gram of gold. This is known as commodity money. Lydian merchants in modern-day Turkey are credited with producing the first official coins around 600 BC, stamped with an emblem to certify their weight and purity. This standardization built further trust in the system. You no longer had to weigh metal for every transaction. You could simply count the coins. This reliance on precious metals, however, had its own limitations. The supply of gold and silver was finite, which could restrict the growth of an economy. Transporting large sums of coins was also risky and heavy. This led to the next great monetary evolution. Representative money. Goldsmiths, who had secure vaults, began issuing paper receipts to people who deposited their gold with them. These receipts were essentially IOUs, promises to pay the bearer a certain amount of gold on demand. People found it was much easier to trade these paper receipts than to carry the actual gold. The paper itself had no intrinsic value, but it represented a real claim on a valuable commodity stored safely elsewhere. This was the birth of the banknote. The paper was valuable because it was backed by, and could be exchanged for, gold or silver. This system, known as the gold standard, dominated the global economy for centuries. A country's currency was directly linked to a specific amount of gold. For example, the US dollar was defined as a certain fraction of an ounce of gold. This provided stability and a predictable measure of value for international trade. However, the gold standard also had rigidities. During economic downturns, governments could unilaterally increase the money supply to stimulate the economy because the amount of money was tied to their limited gold reserves. This became particularly problematic during the Great Depression in the 1930s. Many countries abandoned the gold standard to give their central banks more flexibility to manage their economies. This marked a monumental shift in our understanding of money. Today, most of the world operates on a system of fiat money. The word fiat comes from Latin, meaning let it be done or it shall be. Fiat money is currency that a government has declared to be legal tender, but it is not backed by a physical commodity like gold or silver. Its value comes entirely from the trust and confidence that people have in the government that issues it and its acceptance for trade within the economy. The dollar, the euro, the yen, these are all fiat currencies. Their value is not in the paper they are printed on or the metal in the coins. Their value is derived from a complex social and legal agreement. We accept them as payment because we know that others will also accept them. We know we can use them to pay taxes, buy groceries, and save for the future. This social agreement is maintained by central banks, which manage the money supply to ensure stability. They work to control inflation and maintain public confidence in the currency. If people were to suddenly lose faith in a government or its ability to manage the economy, the value of its fiat currency could collapse. This has happened in several countries throughout history, leading to hyperinflation, where money becomes nearly worthless overnight. The stability of our money rests on a delicate balance of economic policy, institutional credibility, and collective belief. It's a system built almost entirely on trust. The evolution continues into the digital age. When you use a debit card or make an online payment, no physical cash changes hands. Instead, numbers are simply moved between digital ledgers in computer systems. Most money in the modern world exists only as digital entries in bank databases. This is still a form of fiat money, just in a different format. The principles remain the same. The digital dollars in your bank account have value because they are guaranteed by the issuing authority and accepted by everyone in the economy. This shift to digital has made transactions faster and more convenient than ever before, but it also further abstracts money from any physical form. This abstraction highlights the core nature of money. It is fundamentally a system of accounting. It's a way for us to keep track of value, debts, and credits within a society. Whether it's a shell, a coin, a piece of paper, or a digital entry, money serves as a unit of account, a medium of exchange, and a store of value. These three functions are what define it, and all three depend on a shared social consensus. Without our collective agreement to treat these things as valuable, they would be just shells, metal discs, and pieces of paper. This idea of money as a social construct is perhaps one of the most powerful inventions in human history. It has enabled the creation of vast and complex global markets, allowing for specialization and trade on a scale unimaginable in a barter economy. It allows us to translate the value of our labor into a universal form that can be exchanged for an endless variety of goods and services created by others. It connects the work of a farmer in one country with the needs of a consumer in another. This intricate web of economic relationships is all built upon the simple but profound agreement that a particular token has value. It is a testament to our ability as a species to cooperate and build systems based on shared trust. The story of money is the story of human civilization itself, a continuous journey of creating and reinforcing the social agreements that underpin our economic lives.